The majority of all the sales we've done over the last 3, 4 years have been directly attributed to silver. The sales that we've seen since the war has escalated in the Middle East, we've seen a much more uh, concerted drive towards gold over the last couple of weeks because what we're seeing are larger purchases. People saying, "Geez, this is something that is very concerning." And a lot of these people that are buying haven't bought before, and so they're not understanding the value found in silver. They're running to gold because they're afraid of the big geopolitical implications.
Andy Schectman is a renowned bullion dealer, relentless stacker, and president of Miles Franklin Precious Metals. Andy spends much of his time educating investors about growing economic and geopolitical trends and how they affect the precious metals industry. He has been doing this for years, but over the past year or so, Andy has had so much to talk about. One could say much more than usual. The reason for this is easy to understand. The world is at the precipice of a shift. Such a huge shift that all of the events happening seem to be completely unconnected. But experts like Andy have been able to help us see what should have been a glaring connection. On one hand, a majority of the world's governments are actively researching or developing central bank digital currencies. On the other hand, these central banks are actively accumulating tangible assets like gold and silver at probably the fastest pace ever recorded. We are also seeing more and more countries denounce the US and Western dominance over the rest of the world. They are rejecting our faulty debt-based system and gunning for one built on a more solid foundation. Commodities like gold and silver. Then there are all the growing signs of serious economic challenges, like recessions, hyperinflation due to unchecked money printing, and even a 30s-style global depression. To an ordinary onlooker, all of this might look unconnected, but experts like Andy are certain that we are witnessing the beginning of the end for the global monetary system and a permanent shift into another era. Central banks realized this a long time ago, which is no surprise because they started this chain of reaction with their unchecked money printing. Now they want to buy all the real money, gold and silver, while they force the rest of us to accept their CBDCs, which will even be worse than physical fiat currencies. Andy believes that people are now catching on to what is happening and are arming themselves by buying gold. According to the popular bullion dealer, Miles Franklin has been getting more orders of gold than usual, mostly from people who have never bought gold or silver. People are waking up and turning towards gold and silver, the only real money that has served investors through many turbulent eras for thousands of years. We will now bring you clips from Andy's recent interview with Silver Bullion TV. Please watch, share, and like this video, subscribe to the channel, and turn on the notifications bell for more videos. Thanks, and enjoy the video.
We have seen an uptick, most of it in gold, whereas 98% of the business we've done in 4 years has been in silver. And that to me is a little glimpse into the expansion of the mainstream, who are just catching pieces of the narrative. They don't understand the tremendous value in the story behind silver. They simply see that there is a disturbance in the force, and, well, I better do something that is considered historically safe. First place to go to would be gold. So, yeah, I think this is the beginning stages of what is going to be an expansion into the mainstream's collective awareness. When you talk about the yield curve, which has been so massively inverted, uninverting of the yield curve is typically when we see this recession. In fact, if you go back over the last 50 years, I don't think there's been a time ever where the yield curve was inverted, especially the way that it has been over the last year or two, that hadn't been the precursor to recession. The difference is, and to your point, that most of the time we would see that it would be the Fed coming in and lowering the front end of the bond market to stimulate growth. Well, we'll drop short-term interest rates and hopefully people will take loans and speculate, et cetera. It's not been that. In fact, the Fed has been raising the front end of the short end of the curve. And what we have been seeing is the back end rising, not at the behest of the Fed, but at the market directing yields higher, whether it be the fact that, I mean, who the hell wants to buy a 10-year treasury paying less than what a 2-year treasury is? So yields have to go up to chase that. But at the same time, you have a situation where, as with the banks as an example, as depositors are coming in to redeem their deposits, as people in bank accounts say, I want out of the bank. These banks are undercapitalized. They have to sell their 10-year treasuries, which in and of itself You have the government, China, Japan, Saudi Arabia, they're all dumping 10-year treasuries. And as they're selling their treasuries, which have been the worst performing asset period over the last several years. In fact, go back to 2020, this will be the worst bond market disaster in history in terms of a bear market. And so as these sovereign nations and as these banks unload their toxic 10-year treasuries and longer maturities, the back end is rising on its own. And so you have a situation that's doubly troubling as far as I'm concerned. A bond market that I think the Fed is beginning to realize that the market is much bigger, if you will, than the central bank. The market should control the rates, not the Fed. The market should be controlled by, or the rates should be controlled by the natural forces of the market, not by the Federal Reserve. And we're seeing a period of time, Patrick, where foreigners are not buying the treasuries anywhere near the amount that they used to. In fact, the Federal Reserve is probably the biggest buyer of the treasury market.
A few days ago, Moody's, one of the top risk assessment agencies, lowered the United States government's credit ratings outlook from stable to negative, citing political polarization in Congress. Though Moody's still assigns the U.S. its highest AAA credit rating, it's the only one of the three top credit rating agencies to do so. Fitch Ratings downgraded the government's long-term credit rating from AAA to AA+ in August, following the step of Standard & Poor's, which lowered it to AA+ in 2011. A country's credit rating, much like an individual's credit score, shows how agencies like Moody's evaluate the government's ability to pay back its debt obligations. If Moody's changes the U.S. actual credit rating, not just its outlook, the government will have more challenges borrowing as much money. With a $2 trillion budget deficit, $33.7 trillion debt, and rapidly climbing debt expenses, the U.S. cannot afford to not borrow. This means it will have to incentivize buyers with higher interest rates, which, in the long run, only worsens the situation. Let's get back to Andy's interview.
It's a relatively new ideology historically that government debt represents savings. I think they're beginning to realize that that may not be the best pathway, and I think we're seeing a move back to gold as being the preeminent form of savings. And my justification for saying that, it's not that I'm a gold dealer, it's the fact that you have the worst 10-year treasury performance in history last year, coupled with the greatest amount of gold acquisition in history by the central banks. Do you think there's any coincidence in this, that as the central banks are buying gold, they're shedding treasuries? And I don't. And I think that this is a trend that will continue. And we are a country that has signaled more or less that we will choose inflation over austerity. We will choose to not raise yields high enough to break everything apart, and we will inflate our way out of it. But I have said for a very long time that the market has other plans for the treasury market. It will be the dumping of dollars globally that will push rates markedly higher. And then the U.S. has a villain to point to, and it's that those bastards at Xi Jinping and OPEC and Putin, they're the ones who did this to us. And we can get into how I think that happens if you'd like. But the bottom line is that this is a very tenuous situation, and I think the bond market will be something that will be forsaken for quite some time. You know, the illusion of safety in a treasury market that has, in my opinion, lost trust, has lost faith in a country that is 150 trillion in debt. Forget about the 32 trillion. How about the Medicare and the Medicaid, the Social Security, the government military pensions that are 130 trillion? We are indebted. We're borrowing money just to pay the interest on the money we borrowed last. We're 130% debt to GDP. And you know what, Patrick? Anytime a country in history has crossed that Rubicon, it's never come back without defaulting, whether it be outright default or hyperinflation, which is a form of default. So this is stage one of what I believe is a bond market, a debt market, liquidity crisis meltdown. And as it gets worse, which I believe it will ultimately, I think you will find gold and silver being looked at by the world differently than it has in a very long time. You know, they say the more things change, the more they stay the same, or history doesn't completely repeat itself. And, you know, for most of human history, gold and silver have been considered wealth. There's been this period of time in the last 70, 80 years where that was ignored and replaced with debt accumulation instead as a form of savings. I think we are beginning to go back full circle to at least the very, very sophisticated investors, the central banks, who not only have bought more than at any time in history over the last 18 months, their numbers this year are they bought over 800 tons this year. They're up 18 or 20% year over year. They're continuing this trend. So, yeah, I think this is a trend that will continue. And a bond market that anyone who's holding long-term treasuries, I think, needs to really take a hard look at their portfolio. It's something right now that I think could and will prove to be disastrous for those who are still hanging on, like the banks.
Andy believes there are only two ways out for the United States government: a nasty default that brings down everything, or we continue printing and printing until the dollar is practically worthless. The U.S. becomes another Venezuela or the Weimar Republic. A silent third option is an austerity program that will introduce harsh economic policies intended to reduce the huge difference between the government's revenue and massive debts. Though many experts have detailed how the third option will help us rebuild and grow strong again, everyone knows no politician will attempt to even think about it. It's plain political suicide. So the reset is going to happen, and like other resets, the common person is going to bear the brunt of it. Everything will go to zero, and when the protests begin, they will do everyone the huge favor of offering CBDCs. This is why people like Andy have dedicated time to educating us on what's coming, and the urgent need to continue stacking or begin immediately if you don't have any gold and silver. Please share your thoughts on Andy's video. And if you are yet to do so, take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. Thanks for watching.